publication of our monetary policy report. Le gouverneur Macklem va prononcer une déclaration préliminaire et après, on va tourner aux questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. So let's start. I'll turn it over to Governor Macklem for his opening remarks. À vous la parole.
Thank you and good morning. I'm pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy decision and our monetary policy report. Today we maintained our policy interest rate at 5%. We're also continuing our policy of quantitative tightening. Inflation has come down a lot since the summer of 2022, but as every Canadian knows, it's still too high. We held our policy rate steady today because monetary policy is working to cool the economy and relieve price pressures. And we wanted to give it time to do its job. But further easing in inflation is likely to be slow, and inflationary risks have increased. Aujourd'hui, nous avons maintenu le taux directeur à 5% et nous poursuivons notre politique de resserrement quantitatif. L'inflation a beaucoup baissé depuis l'été 2022. Mais comme tout le monde le sait, elle est encore trop élevée. Nous avons laissé le taux au même niveau parce que la politique monétaire est en train de ralentir l'économie. Themes and talk about the implications for monetary policy. Global economic growth is slowing as expected as higher interest rates and tighter financial conditions restrain demand. But the composition is a bit different from what we forecast in July. The U.S. economy has been surprisingly strong, while China has slowed more than expected. At the same time, geopolitical tensions have increased. The Russian war of aggression against Ukraine continues, and Hamas attacks in Israel have ignited conflict in Israel and Gaza. These wars are causing incalculable human suffering. They're also hurting the global economy and adding uncertainty to the outlook. In Canada, the economy has slowed, and the data suggests that demand and supply are now approaching balance. With the economy expected to move into excess supply this year, and with growth anticipated to be weak for the next few quarters, price pressures should ease further. We expect inflation to ease gradually and return to the 2% target in 2025. But we're worried that higher energy prices and persistence in underlying inflation are slowing progress. Since the July NPR, we've seen clear evidence that higher interest rates are moderating spending and rebalancing demand and supply. Economic growth has slowed over the past year, averaging about 1%. Household credit growth has softened, and so has demand for housing and many durable goods. And more recently, we're seeing the service sector slow as well. With consumer spending expected to remain subdued through most of 2024, we've revised down our growth outlook. GDP growth is forecast to remain below 1% for the next several quarters before picking up in late 2024 and rising to 2.5% in 2025. Comme vous le savez, nous suivons de près les indicateurs de l'équilibre entre l'offre et la demande. En ce moment, ils ne vont pas tous dans le même sens. Selon les estimations de l'écart de production, l'équilibre serait déjà atteint. L'offre aurait même légèrement dépassé la demande. Selon les indicateurs du marché du travail, les fortes pénuries de travailleurs auraient beaucoup diminué, mais le marché serait encore plutôt tendu. Le nombre de postes vacants a baissé, mais reste plus élevé que la normale. Et malgré une légère hausse, le taux de chômage demeure bas. La croissance des salaires reste forte et elle se situe entre 4 et 5%. Ce qui est plus clair, c'est que les pressions de la demande ont diminué plus vite que prévu en juillet. So what does this mean for inflation? We are already seeing more evidence that tighter monetary policy is reducing price pressures for many goods and services. And with the economy already or soon to be in excess supply, more downward pressure on inflation should be in the pipeline. But our outlook for near-term inflation is higher. Let me explain. The effects of higher interest rates are most evident in the prices for durable goods like furniture and appliances that people often buy on credit. And these effects have also spread to many semi-durables, a category that includes things like clothing and footwear, as well as many services excluding shelter. Inflation in these categories is now running generally at or below 2%. Price increases for groceries, while still elevated at almost 6%, have also eased and are expected to moderate further. Despite this, we've revised up our outlook for inflation. Higher energy prices, structural pressures in our housing market, and stickiness in underlying inflation are all slowing the return to target. Higher global oil prices have driven up gasoline prices, and we now expect oil prices to remain higher than we assumed in July. Inflation in shelter services is running above 6%. Part of this is due to higher mortgage interest costs following increases in our own policy interest rate. But it also reflects higher rents and other housing costs, and these pressures are more related to the structural shortage of housing supply. Finally, near-term inflation expectations and wage growth remain elevated, and corporate pricing behavior is normalizing only slowly. All this is making underlying inflation more persistent. The combined impact of all these factors is that we now expect inflation to be about 3.5% through till about the middle of next year. As excess supply in the economy increases, inflation should ease further in 2024 and reach 2% in 2025. There are both upside and downside risks to this inflation forecast, and the future path for inflation is uncertain. Overall, inflationary risks have increased since July. Today's forecast has inflation on a higher path than we expected. In addition, rising global tensions are increasing risks. In a more hostile world, energy prices could move up sharply, supply chains could become disrupted again, and all of that could push up inflation again around the world. To be confident that our policy rate is high enough to get inflation back to 2%, we need to see more easing in our measures of core inflation. We remain focused on a number of indicators of underlying inflationary pressures, particularly the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. Les signes que la politique monétaire fonctionne sont plus clairs. Par conséquent, le Conseil de direction a décidé d'être patient et de maintenir le taux directeur à 5%. Nous allons continuer d'évaluer si la politique monétaire est assez restrictive pour rétablir la stabilité des prix. Et nous allons surveiller les risques de près. La décision aujourd'hui montre aussi que nous tentons de doser notre resserrement monétaire le mieux possible. Nous ne voulons pas ralentir l'économie plus que nécessaire. Et nous ne voulons pas que les Canadiennes et les Canadiens continuent de vivre avec l'inflation élevée. Il ne faut pas qu'elle s'enracine. Si les pressions inflationnistes continuent, nous sommes prêts à relever encore le taux directeur pour rétablir la stabilité des prix. With clearer evidence that monetary policy is working, Governing Council's collective judgment was that we could be patient and hold the policy rate at 5%. We will continue to assess whether monetary policy is sufficiently restrictive to restore price stability, and we will monitor risks closely. Today's decision also reflected our best efforts to balance the risks of over and under tightening. We don't want to cool the economy more than necessary, but we don't want Canadians to have to continue to live with elevated inflation either, and we cannot let high inflation become entrenched in the economy. If inflationary pressures persist, we are prepared to raise our policy rate further to restore price stability. We've made a lot of progress, but we're not there yet. We need to stay the course. When price stability is restored, the economy will work better for everyone. And with that, summary, Senior Deputy Governor and I would be pleased to take your questions. Thank you.
Thank you very much, Governor. I'll quickly do the housekeeping rules, then we'll get to your questions. We have a number of reporters here in Ottawa at the bank. We have a number on teleconference across the country. I'll start here in the room. I'm going to ask everyone to please limit yourself to one question so that we can maximize the chances of getting every outlet an opportunity to participate. I'll remind the people on the teleconference to come off mute only to ask your question and then go back on mute as soon as you're finished so that everybody can hear the response. Avant de poser une question, veuillez vous identifier et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So with that, let's get going. I'll start here in the room. Steve Shear from Reuters, please.
Morning, Governor. The Canadian dollar hit a 7-month low against the U.S. dollar today. How concerned is the bank that a weaker currency will make it more difficult to reduce inflation going forward, especially given what you noted in the NPR that the U.S. economy is doing better than had been expected a few months ago?
Well, first point, as you're well aware, we don't target the exchange rate. We target inflation, and the exchange rate is part of how monetary policy works. What is a bit unusual through this tightening cycle that we've been through is normally when we raise interest rates a lot, that causes the exchange rate to appreciate. That helps slow foreign demand for Canadian products, and it also has a direct effect. It reduces inflation in import prices. So because we've been moving rates up in a roughly similar fashion as other central banks, particularly the Fed, what you've seen is that the Canadian dollar has been reasonably stable, down a little bit against the U.S. dollar, up against most other currencies. So now we are getting, because the U.S. is raising rates a lot, that is restraining demand for Canadian exports. So we're getting that part of the effect. What we're not getting is the direct effect of an appreciation to lower in imported inflation. So I mean, that does mean, everything else equal, we got to rely more on interest rates. So that is something, we've had to take into account. But as I said, we don't target the exchange rate, we take it into account. It's determined by market factors.
Okay, our next question will come down here to Randy Van Tong Knight from Bloomberg, please.
Hi, Governor. You said you're still prepared to raise rates again if inflationary pressures persist, but what does that look like numerically? What do you need to see happen in the near term to prompt another hike?
So first of all, we decided to hold the policy rate today because we are seeing clear evidence that higher interest rates are slowing the economy, and that's cooling inflation. But we did leave the door open to higher interest rates if needed. To be confident the policy rate is high enough to get inflation back to 2%, we need to see downward momentum in our measures of core inflation. Core inflation on a year-over-year basis has come down, but if you look over the last good 8 months or so, on a 3-month basis, there's really been very little downward momentum. We need to see clear downward momentum in core inflation. And there are a number of indicators that we're watching closely there's a number of indicators of underlying inflation that we're watching closely in that regard. And we've been pretty clear what those are: the balance between demand and supply in the economy, wage growth, corporate pricing behavior, and inflation expectations. We're going to take our decisions one at a time based on the best available data and information at the time of that decision. If inflationary pressures persist, we have been very clear. We're prepared to raise our policy rate further if that's needed.
Thank you. We'll go next to Najoud Al-Maliz from Canadian Press.
Hi, Governor. One of the upside risks outlined in the report is the war and the effect it could have on energy prices. The monetary policy report also touches, I think that one, it touches on essentially how that kind of shock would play out differently right now because of inflation expectations, because of corporate pricing behavior. So I'm wondering, that would be out of your control, a global shock, but I'm wondering how would the Bank of Canada handle something like that, given the inflationary period right now and those dynamics you're concerned about?
Well, 2 points. First of all, we've already built in a higher path for oil prices into the projection that we published. We raised the path for oil prices by about $10 relative to July. So part of that risk is built in. But look, I'm no military expert, but it's clear there are risks that tension in the Middle East could escalate, and you could see an even bigger increase in prices. So how would we handle that? So, if inflation was at 2% and the economy was reasonably imbalanced and inflation expectations were well anchored on 2% on the 2% target, typically we would tend to largely look through that. And the reason for that is it takes time for monetary policy to work. These increases in oil prices, they tend to go up, and then after a period they tend to come back down. So by the time monetary policy is really working, the shock's gone away. However, that's not the situation we're in right now. Inflation's been above the target for 2 years. Inflation expectations, near-term inflation expectations are still above the target. They're actually even above our own forecast. And as you highlighted, corporate pricing behavior is not normal. What we've seen is companies are passing through higher input costs more quickly than usual to final prices. So consumers are feeling it right away. So against that environment, we would need to be more cautious than normal about seeing through it. And what we'd be particularly focused on is the impacts on core inflation. If we saw evidence that higher energy prices were passing through to broader prices because of higher transportation costs, for example, that would be a signal that that increase in oil prices is starting to feed through to the rest of the economy, and that would really be something of concern to us.
We'll go now to Jordan Gowling from CTV, please.
Hi, Governor. In the NPR, you talk about one of the downside risks. You talk about bond yields not having been this high since before the 2008 financial crisis. How concerned are you about the potential for a global economic slowdown? Thanks.
Yeah, why don't you take that one?
Sure.
Yeah, I mean, we've seen bond yields, particularly at the long end, increase pretty sharply recently. There's a number of factors that are contributing to that. Certainly, I think markets are adjusting to the fact that inflation is looking sticky, and the prospect that rates are going to need to be higher for longer is coming into how they're pricing yields at the long end. There's also some structural elements. The U.S. deficit means there's a lot more bonds being issued in the U.S. market, and that increased supply has to be absorbed, which is going to push prices up a bit. And there's term premium. The markets are demanding higher rates for longer term assets and also for the volatility. So, market conditions are an important input. They're not a determinant to our price decisions. They definitely come in. They're one of the inputs we use, but they're one of many.
Okay, thank you. We'll go now to Mark Rendell from the Globe and Mail, please.
Sorry about that. How's that? There's a considerable downgrade in the economic growth forecast between the July NPR and the NPR we saw today. And I'm wondering, I guess, what were you not seeing in July that you're seeing now that's led to this significant downgrade in both Q2 and Q3 estimations? And then looking forward, does this weaker economic growth outlook imply that you're expecting a recession in the coming quarters?
Yes. So we have downgraded our growth outlook. And there are really two parts to that. Part of it is the data we've been receiving. We've been expecting the economy to slow. And the data we've been receiving is showing that slowing. And in fact, the economy has slowed a little more than we were predicting back in July. And so what that means is that there's less excess demand in the economy than we thought. And in fact, our measures of the demand-supply balance in the economy now are kind of mixed, which is what you'd expect as you're approaching balance. So the data we've seen, as I said, we've expected a slowing. We've seen a little more slowing. And that, I think, really, it's hard to be super precise why it slowed a little more, but I think our take is you're seeing a little more traction from monetary policy. It was a bit slow at the beginning. It's picked up. The traction has picked up. Going forward, we've also downgraded our outlook over the next few quarters. We're expecting growth below 1% for the next 3-4 quarters. In terms of, is that a recession? No, it's not a recession. It's low positive growth. Having said that, if you're predicting low positive growth, you can't rule out that, we're talking about small positive numbers. You can't rule out we're going to get some small negative numbers. So there could certainly be 2 or 3, small negative quarters. When people say the word recession, I think what they have in mind is a steep contraction in output and a large rise in unemployment. That's not what we're forecasting. I'll just close by saying, we've been saying for some time that the path to a soft landing is narrow. And in this projection, that path has gotten narrower. We've got, our near-term inflation forecast is a little higher. Our near-term output forecast is a bit lower. That path is getting narrower. But it is a path where the economy goes through a period of very weak growth and then comes out of that late 24 and through 25.
Okay, Raul from Epoch Times, you're up next, please.
Yes, thank you for taking my question. Just about the surprising strength in the U.S. economy and comparing it to Canada's, how much more is it than the difference in consumer spending, where in the U.S. the consumer spends a lot, and in Canada now it's more saving, and how much is it versus things like productivity and business investment, which are also weak in Canada? So that difference in growth between the two countries, is it more sort of longer lasting or systemic than just the consumer? And just trying to understand what is the surprising part about the U.S. economy strength and kind of how that speaks to what's happening in Canada. Thank you.
Well, the short answer is probably all those things, but I think I would point to a few things in particular. So for one thing, the structure of our mortgage market is different in Canada than the United States. The United States, they have 30-year mortgages. Canada, the sort of benchmark is 5 years. Some people have shorter than 5 years. Some people have variable. So so what that means is people's mortgages reset faster in Canada. So other things equal, you'd expect monetary policy to have more traction in Canada, and that's what we're seeing. Consumption has slowed more in Canada than it has in the United States. The other thing, when you compare Canada and the United States, is so households in both Canada and the United States, and in fact almost every other country, saved a lot during COVID because they couldn't buy a lot of the services they wanted to consume. So they came out of COVID with this buffer of extra savings. In Canada, that extra savings has largely been saved. Consumption patterns have gone back to normal, but they still have that extra accumulated savings. And it looks like to a large extent, people know their mortgages are going to reset. They're putting it in a GIC, so they're ready for that. In the United States, they've spent most of that extra savings, and so consumption has been stronger in the United States. And you're seeing that through the recent data. Our own forecast has, with that stock of extra savings largely diminished, we do see consumption growth slowing more in the U.S. going forward. That's built into our forecast. So those are a couple differences. A longer term issue is around productivity growth. Canada has been very good at growing its economy by adding workers. We have high rates of participation. We have high rates of immigration. We're very good at integrating new immigrants into the economy. So if you look over the last 20 years, we've grown roughly about the same as the U.S., but the composition of that growth has been very different. Our growth has been more through adding workers. Their growth has been more through productivity. Where we are, and we're still, we're seeing that in the current cycle. Productivity growth in Canada has been pretty flat. It is growing in the U.S. And to be frank, productivity growth makes everything easier. It pays for higher wages without stoking inflation. It supports non-inflationary growth. So, that is another difference between Canada and the United States.
Okay, our next question will come from Mackenzie Gray from Global News, please.
Hi there. On housing, they're talking the monetary policy report about how generally in cycles where we see higher interest rates, house prices would come down more than what we've seen. Can you explain why that's happened in this situation and what your level of concern is for Canadians who had a much lower interest rate who are now going to have to renew in the coming months or years into a much higher interest rate?
You've got sort of two separate questions there, so try and answer both. I mean, you're right, and we talk about this in the monetary policy report this time. Normally, house prices move pretty lockstep with interest rate increases. As interest rate increases, most Canadians buy houses with credit, so they're one of the first things that respond to monetary policy. As interest rates come down, house prices will move up a bit, and they'll come off as interest rates come back up. We haven't seen that same dynamic. They've come off a bit this time, but we're not seeing, relative to the degree of rate increases, we're not seeing the decline in house prices that we would expect. That really comes down to the thing that we've talked about many times, which is there is a structural lack of supply in the Canadian housing market. So really, until we address that supply issue, interest rates on their own are not going to help us get back to a housing affordability situation or solution. So, we're really pleased to see the degree of focus that governments are putting on this issue right now. That'll help if we can address that sort of structural imbalance. Not only will that help housing affordability, it'll help inflationary pressures too. So it's one of the things that's kind of getting in the way of progress. Your second question, I mean, we are paying really close attention to the mortgage renewal cycle. It's one of the things the governor just talked about a few minutes ago. It's one of the things that, is basically it's monetary policy at work. As more households renew their mortgage at a higher rate, it puts, downward pressure on spending. They have less money available to spend on other things. That dampens demand. That sort of gets the economy back in balance. We are watching for the financial pressure that comes with that. We usually talk about that more in our financial system review. We've got an update to that coming in November, and you'll hear more from us on that at that point.
Okay, next is Kevin Carmichael from The Logic, please.
Governor, to what extent is fiscal policy contributing to the stickiness of inflation that you're observing? And are there things that governments could do to supplement your efforts to bring inflation down?
Fiscal policy. First thing I need to say on fiscal policy is that we don't set fiscal policy, and fiscal policy is appropriately the decision of elected officials and ultimately parliaments. Governments have a lot of priorities. It's a difficult job. It is appropriate, though, for us to comment on how fiscal policy is impacting inflation. So I will say a few words on that. There's different ways to look at it, but one way to look at it is look at the growth of government spending. So our best estimate is the potential output in the economy is growing at about 2%. So supply in the economy is expanding at around 2%. So if government spending is growing at 2% or less, it's not, adding more demand. It's not adding faster to demand than supply is growing. So it's not adding sort of undue inflationary pressures. So if you look at government spending over the last year, it was it was below 2%. So it doesn't look like it's been adding undue inflationary pressures over the last year or so. If you look at our forecast in the monetary policy report, what you can see is that when we add up the spending plans in the budgets of all levels of government, provincial, federal, for next year, we expect government spending to grow at about 2.5%. So what that means is if all those spending plans are realized, government spending will be adding to demand more than supply is growing. And in an environment where we're trying to moderate spending and get inflation down, that's not helpful. More generally, what I would say is that governments are hearing from their constituents. They are thinking more about the impact of inflation. They're thinking more about the impact of higher interest rates. And I think that's a good thing. And in that regard, it would be helpful if governments considered the inflationary impact of their spending decisions when they're making their spending plans. It's going to be easier to get inflation down if monetary and fiscal policy are rowing in the same direction.
OK, la prochaine question maintenant vient de Raymond Filion du réseau TVA.
Bonjour, j'aimerais vous entendre, M. Macklem, sur une éventuelle baisse du taux directeur avec vos prévisions sur l'inflation aujourd'hui. J'imagine que ce n'est pas encourageant pour les détenteurs d'hypothèques. À quel moment les gens, le public, peut espérer une baisse des taux d'intérêt?
Vous avez raison. Quand l'inflation est à notre cible de 2 %, les taux d'intérêt peuvent être plus bas. Et même, on peut commencer à réduire nos taux directeurs avant que c'est à 2 % parce qu'on devrait essayer de voir où l'inflation s'en va. Mais ce n'est pas le moment maintenant de discuter les baisses de nos taux directeurs. Qu'est-ce que nous avons dit aujourd'hui? On a laissé notre taux directeur à 5 % et on est en train d'évaluer si nous avons haussé nos taux directeurs assez pour ramener l'inflation à 2 %. Quand est-ce que c'est le moment d'avoir cette discussion? Quand il y a les signes qui sont très clairs que l'inflation descend vers 2 %, ce sera le temps d'avoir ces discussions, mais maintenant, c'est trop tôt.
Okay, we have the last two questions here in the room. First, Paul Vieira from the Wall Street Journal, please.
Governor, you said earlier that you're not forecasting a recession. You called it low positive growth, but is it fair to say that has Canada entered a period of stagflation?
Paul, it's not a word I would use. I grew up in the 1970s. Stagflation to me is a period of high inflation and high unemployment. That's not what we're in now. Yeah, inflation's well above our target. It's too high, but I wouldn't say it's not high like it was in the 70s. And the unemployment rate actually is quite low. At 5.5%, it's below historical norms. It is true that in this forecast we've revised down our growth forecast and revised up our inflation forecast in the near term. So what is going on there? And what I want to underline is we can actually see, and there's I think box 4 in the monetary policy report does a good job of digging into this. You can see the effects of higher interest rates cooling the economy. You can see that transmitting into lower inflation for many goods and services. But the problem is there's some things that are getting in the way. And in particular, higher oil prices and the structural supply shortages we have in our housing market. So combine that with wage growth that's running at 4 to 5%, inflation expectations that are sticky, and corporate pricing behavior that hasn't normalized. All that means is all that is creating more persistence in inflation than we'd hoped. So yes, we have lowered our GDP forecast and raised our inflation forecast. Ultimately, that slowing in the economy is going to build up excess supply, and ultimately that will bring inflation back down to target, but it is going more slowly than we'd hoped.
And finally, here in the room, Greg Quinn from Market News, please.
Good morning. The statement again mentions that inflation could return to target around the middle of 2025. I'm wondering in general how confident you are about this time frame, given all the bumps we've had, and given all the revisions to the forecast in this outlook. Has that confidence changed in the last couple of months?
Well, what has changed in the last couple of months is, and we were very clear on that, inflationary risks have increased since our July monetary policy report. And there are really two reasons for that. One is, if you look at our forecasted track for inflation in the near term, it's higher than it was in July. It's running around 3.5 to the middle of 2024. Last July, we were around 3. So it's moved up. So, we're further from our target. We're starting in a worse place. And the other factor is oil prices. As I indicated, we've built higher $10 higher oil prices into our forecast, but given increased geopolitical tensions, the risks that oil price could go a lot higher have increased. And related to that, if you see an escalation of conflict, if you see an escalation of geopolitical tensions, there's also potential for some new supply chain disruptions. All that could boost inflation around the world, and we will not be immune to that. So we do think those inflationary risks have increased. At the same time, we're also seeing clearer evidence that monetary policy is working through the economy, that is rebalancing demand and supply, that is relieving price pressures. And at the end of the day, that's why we held our interest rate at 5%. And agreed that we're going to have to continue to assess whether we've done enough, and we're going to have to monitor those risks very closely.
Okay, we're going to go to the teleconference now. I've got about 7 minutes left, and we've got about 7 people on my list, so let's see how we do. Max Sato from Mace News, can you please come off mute and ask your question?
Thank you, Paul. Thank you, Governor. My question is about geopolitical risks. How do you think those risks are affecting people's plans to spend and invest? I'm talking about households and businesses. Thank you.
I'll be honest. I think it's very hard to tell. I think you can't turn the television on without being deeply disturbed by the human suffering that these conflicts are causing. Exactly how that translates into people's spending patterns, I think, is difficult to assess, and we'll have to keep monitoring that.
Okay, next I've got Rob McClister from Mortgage Logic News. Rob, go ahead, please.
Hi, Governor and Senior Deputy Governor. In a scenario where U.S. Treasury yields were to continue running higher, not because of inflation, but because of concerns over U.S. deficits and Treasury supply, could those higher yields be inflationary or disinflationary to Canada, other things equal? And what kind of risk would such a run-up in U.S. yields create for Canadian monetary policy?
Hi, Rob. Thanks for the question. I mean, we talked about this a little bit earlier. I guess what I would say is to the degree that the uptick in yields is reflecting what markets think monetary policy is doing, it's not a substitute for what the bank needs to do. To the degree that the increase in yields is sort of adding to what central banks are doing, it could be a bit of an offset to future increases, but it's really hard to disentangle the effects on yields. And to your point, I mean, what we've seen in the U.S. is not the same degree of increases we've seen here in Canada. So So remains to be seen, I guess.
Okay, next we've got Amber Kanwar from Bloomberg BNN, please.
Hi there. Many Canadians have been able to withstand rising rates through their mortgages by extending their amortization. That starts to run out as we get to the end of 2024 and 2025, at the same time that you see growth picking up. My question is, are you worried that people having to refinance at higher rates, if we are indeed higher for longer, is at odds with your growth forecast? And would the only way to mitigate that, I guess, be through rate cuts?
Well, look, we target inflation. We don't target interest rates, and we in particular don't target mortgage interest rates. We do track mortgage renewals as one of the key transmission mechanisms for monetary policy. We are aware that as we approach sort of the next couple of years, we do have a good portion of Canadians that are renewing from particularly low levels in their mortgage, and that will have effect on spending. I don't think that we view those at odds with our growth forecast. It is something we pay close attention to. Ultimately, as the governor said earlier, the discussion around when we can decrease interest rates has to do with inflation. When we see inflation is sustainably back to target, that's when we'll start having a discussion about reducing rates.
Okay, Barbara Schechter from Financial Post. Please come off mute.
Yes, hello. I just wanted to ask, you talked about the narrow landing or narrower runway for a soft landing. And I wonder if there's any consideration given to sentiment. I mean, the recession word even being discussed and people who raise it, it's got a bit of a psychological aspect to it. So when you make your decisions, are you going to do anything to stay on the side of the low positive growth just to keep sentiment from getting a little bit out of control?
Well, I think the way to answer your question is, so certainly Canadians' perspectives, their concerns, their worries, to use your word, their sentiment, that is something that feeds into our decisions. That affects their spending decisions. That affects growth in the economy. That affects inflationary pressures. So that is something that we take into account. We survey Canadian households and Canadian businesses on a quarterly basis. In fact, just before this decision, we published our latest survey of Canadians and Canadian businesses. Canadians, we have regional offices across the country: Halifax, Montreal, Toronto, Calgary, Vancouver. They interact with the communities where they work. So through these means, we do get a good sense of how Canadians are feeling, what their plans are. And for example, you look at the survey results we published about a week ago. When we ask Canadians, it's clear that the combination of higher inflation and higher interest rates is causing them to restrain their spending. We can see that in the data we have, and they're telling us that that's going to continue, and that's something that we take into account as we forecast our economy. We've got very weak growth for the next several quarters before growth starts to pick up late in 2024 and through 2025. So that is something that we take into account. As we highlighted, there are always risks around our outlook. Sentiment could deteriorate more than we expect. It could have a bigger effect on spending. On the other hand, Canadians have proved remarkably resilient. Spending could be stronger than we expect, and that's something we'll be assessing at each meeting going forward.
Okay, next I've got Pete Evans from CBC. Go ahead, Pete.
Hi, I know your statement makes it clear that you're prepared to raise rates again if necessary, but is there any one particular factor that you're most worried about on the upside right now? I mean, like GDP and jobs both seem to be moving below trend. What would it take to hike? Or is this more a case of talking up the threat of a hike enough to achieve your goals of reducing spending? If you could answer in English and French, that'd be appreciated.
English and French, certainly. So, look, what we're focused on is inflation. There's always going to be a certain amount of volatility in headline CPI inflation. And so we spend a lot of time trying to look through that and assess underlying inflationary pressures. We're very focused on our measures of core inflation. And we've been very clear. We want to see clear evidence that core inflation is moving down. That will give us more confidence that headline inflation will move down towards our target on a sustainable basis. In assessing, so we have two preferred measures of core inflation, CPI trim, CPI median. We're going to be watching those very closely. We're going to be taking those apart. There are also a number, we have to be forward-looking. And so to be forward-looking, there's a few guideposts we use, things that we know affect underlying inflation. And those are the balance between demand and supply in the economy. Wage growth at 4 to 5% with virtually no productivity growth is not consistent with getting inflation back to our target. Corporate pricing behavior, when inflation went up a lot, we saw companies were increasing their prices more frequently, and they were increasing them by more. That has started to normalize, but it's still not back to normal. So we're going to be watching those things for if those things are starting to normalize, our confidence that underlying inflationary pressures are coming down, and we probably won't have to raise interest rates. But we've been very deliberate. We're leaving the door open to further interest rate increases because there is uncertainty about that. And if we see inflationary pressures persist, we are prepared to raise our interest rate further. Et puis en français, notre phare, c'est notre cible d'inflation. On sait qu'il y a une certaine volatilité dans l'IPC total et donc on regarde de près notre mesure d'inflation fondamentale. Qu'est-ce qu'on veut voir? Ce sont des signes clairs que l'inflation fondamentale baisse. Récemment, surtout avec les taux à 3 mois, c'est relativement stable. On devrait voir une tendance à la baisse de notre mesure d'inflation fondamentale. Pour essayer d'évaluer les pressions inflationnistes, on utilise plusieurs indicateurs et nous étions très clairs que maintenant on regarde de près l'équilibre entre demande et offre, les anticipations d'inflation, le taux de croissance des salaires et le comportement des entreprises vis-à-vis les prix. Donc, on va continuer de suivre ça de près. Si on voit une diminution de notre mesure d'inflation fondamentale, probablement, on n'aura pas besoin de hausser encore les taux d'intérêt, mais si les pressions inflationnistes persistent, nous sommes prêts à augmenter notre taux directeur pour ramener l'inflation à la cible de 2%.
Okay, very quickly, our last two questions. First, Mary Brooke from Island Social Trends. Please come off mute.
Hi, a few questions regarding the food and grocery sector. Were you surprised? Did you expect the cost of food to rise so dramatically under the influence of inflation and remain so sticky there? And what needs to happen for that to come down? And also, how much do you factor in the Food Banks Canada type of data for the influence of inflation on people?
Were we surprised by the very rapid run-up in food prices? We were. Part of this was related to global harvests. Of course, those are very hard to predict. But of course, when Russia invaded Ukraine, which is a major wheat producer in particular, this had a big impact on wheat prices. That reverberates through all kinds of food products. We did not foresee that. Food price inflation has been very high. When you look at and it's been really sort of across the food spectrum. So unfortunately, there's this is a problem with inflation. When it becomes broad-based, there's just no way to avoid it. And there's no question food price inflation has particularly affected lower income, more vulnerable members of society. This is an important reason why we've got to get inflation down. If you look at the input, if you look at agricultural prices, they have come down a fair amount, and you are seeing food price inflation come down with a lag. It's running, the latest year-over-year number is about 6%. On a 3-month basis, it's just under 4%. So, what that's telling you is we should see some continued easing in house price inflation, and I think that will be a relief to all Canadians.
And finally, we have Alicia Sikirska from Yahoo Finance. Go ahead, please, Alicia.
Thank you. You mentioned corporate pricing behavior and that it's a risk to high inflation expectations. Why do you think that price setting dynamic has been so slow or gradual to improve? And what changes are you looking for going forward?
Well, it's probably have to ask companies why it's been slow. I think the reality is when we had a long period of relatively low, stable inflation. And in that environment, companies didn't change their prices that often, and they didn't usually change them by a lot. And the thing about low inflation is that it reinforces those competitive forces in the economy. We did have increases, we did have fluctuations in oil prices over the last 25 years. We have had big changes in input costs, but when inflation was overall pretty low, what we heard from companies is they're very reluctant to increase their prices because they're going to lose customers. But when the economy was overheated and all prices were going up, companies were much more willing to just pass through higher input costs into final prices. They had very strong demand for their products. They were having trouble keeping up. They weren't as worried about losing customers, so they passed on higher prices very quickly to consumers. So consumers, bore the full brunt very quickly. As the economy has come into better balance, we are seeing that normalize. But yes, when behavior changes, it takes time for behavior to revert back to normal. We're certainly looking, very carefully for further evidence that the pricing behavior of companies is normalizing. And actually, our colleague Nicolas Vincent gave a whole speech on this a couple of weeks ago, where he digs into various elements in a lot more detail.